Crypto versus traditional banking, who wins? The rise of cryptocurrency has sparked countless debates about its potential to disrupt the traditional financial system. For many, the promise of decentralized finance, DeFi, represents a revolutionary shift, offering a level of transparency, efficiency, and independence that traditional banking can't match. On the other hand, conventional banks bring stability, regulation, and consumer trust, attributes that cryptocurrencies often struggle with. To assess which is better, it's important to delve deeply into the key characteristics of both systems, examining their strengths, weaknesses, and the roles they might play in the future of finance. Traditional banking, backbone of the financial system. Traditional banking has long been the backbone of the global financial system. From savings accounts and loans to facilitating commerce, banks play a crucial role in maintaining economic stability and growth. Banks serve as intermediaries between depositors and borrowers, and their regulated status provides a safety net for consumers. Banks operate under strict government regulations. These rules ensure the safety of deposits, control the financial ecosystem stability, and protect consumers from predatory practices. For instance, the FDIC in the United States ensures deposits, providing a sense of security for individuals and businesses. Banks have centuries of history behind them, which builds trust. People trust banks to keep their money safe, provide financial services, and support them in times of need. Banks are also integrated into global financial infrastructure, meaning they provide a seamless way to facilitate international transactions. Banks also play a critical role in credit creation, which is fundamental to economic growth. By issuing loans, they enable individuals to make significant purchases, like homes and cars, and businesses to expand operations. The lending process is carefully regulated to balance risk and support economic stability. However, traditional banking comes with its own set of limitations. Banks charge fees for their services, which can be costly, especially for international transactions. Moreover, the involvement of intermediaries often means slower processing times and less transparency. Cryptocurrency, a new financial paradigm. Cryptocurrency, first introduced with Bitcoin in 2009, was designed as an alternative to traditional finance. It promised a peer-to-peer system where individuals could transfer value without the need for intermediaries like banks. This concept of decentralization lies at the heart of cryptocurrency's appeal. Cryptocurrencies operate on blockchain technology, which is a decentralized ledger. Unlike banks, no central authority controls a blockchain. Instead, a network of nodes collectively maintains it. This independence from central banks and governments makes cryptocurrency attractive for those who seek greater financial freedom. Blockchain technology ensures transparency, as every transaction is recorded on a public ledger that anyone can access. The cryptographic nature of blockchain also provides security, making it difficult for transactions to be altered or hacked. In contrast, traditional banks are vulnerable to fraud and cyberattacks, and their operations are often opaque. Cryptocurrency transactions can be processed more quickly and at a lower cost compared to traditional banking, especially for international transfers. Cross-border payments, which can take days to clear in the banking system, can be completed within minutes using cryptocurrencies, often with negligible fees. Despite these advantages, cryptocurrencies also have significant drawbacks. Their volatility is a major concern, making them a risky store of value. Regulatory uncertainty is another issue, with governments around the world still grappling with how to regulate digital currencies. Moreover, the decentralized nature of cryptocurrencies means that users lack the consumer protections that traditional banks provide. Accessibility and financial inclusion. Traditional banking is well established but often requires extensive paperwork and verification, which can exclude a significant portion of the global population. According to the World Bank, about 1.4 billion adults globally remain unbanked, often due to a lack of identification, physical distance from banks, or mistrust of the financial system. Cryptocurrencies offer greater financial inclusion. Anyone with internet access can create a digital wallet and participate in the crypto economy. This inclusiveness can empower individuals in developing countries who lack access to traditional banking services. However, the requirement for internet access still poses a challenge in underserved regions. Trust, security, and consumer protections. Banks derive trust from their regulated nature and historical reliability. Deposit insurance, government oversight, and fraud prevention measures all contribute to customer confidence. However, banks are vulnerable to cyberattacks, and instances of fraud do occur. Cryptocurrencies rely on cryptographic security and blockchain transparency. While blockchain technology itself is secure, vulnerabilities exist in the form of hacks on exchanges or wallets. The lack of regulatory oversight also means that if something goes wrong, such as losing private keys or falling victim to a scam, there's little recourse for the user. Transaction speed and cost. Traditional banking transactions, especially international ones, can be slow and costly. A cross-border transfer might take several days to complete due to multiple intermediaries involved. Fees are often high, particularly for remittances and currency exchanges. Blockchain technology facilitates faster and often cheaper transactions, regardless of geographical location. Bitcoin, for example, can settle transactions in minutes, while newer blockchains like Solana and Avalanche offer even faster processing times. Transaction fees vary by network but are generally lower than traditional wire transfer fees, especially for international payments. Regulation and consumer safety. Banks are heavily regulated to maintain financial stability, prevent money laundering, and protect consumers. This regulation provides a safety net for customers but can also stifle innovation and efficiency due to bureaucratic procedures. The regulatory landscape for cryptocurrencies is still evolving. While some countries have embraced them, others have imposed strict regulations or outright bans. The lack of consistent regulation creates uncertainty for investors and businesses looking to adopt crypto solutions. Additionally, the anonymity associated with some cryptocurrencies has made them attractive for illicit activities, further complicating regulatory efforts. The future of finance, coexistence or competition. The future of finance may not necessarily involve one system triumphing over the other. Instead, cryptocurrencies and traditional banking could coexist, each serving distinct needs within the broader financial ecosystem. Central banks around the world are exploring or launching their own digital currencies, CBDCs. These are essentially digital versions of fiat currencies, combining the stability of traditional banking with some of the technological benefits of cryptocurrency. CBDCs could streamline payment systems, improve monetary policy efficiency, and offer an alternative to decentralized cryptocurrencies. Traditional banks are beginning to adopt blockchain technology to improve their services. Blockchain can streamline processes like clearing and settlement, reduce fraud, and provide greater transparency in financial transactions. For example, JP Morgan has developed its own digital coin, JP Morgan Coin, to facilitate instant payments. Decentralized finance, DeFi, platforms aim to offer financial services without intermediaries, allowing users to borrow, lend, and earn interest on their digital assets. Some traditional banks are exploring partnerships with DeFi platforms to integrate blockchain technology into their operations, potentially leading to hybrid solutions that offer the best of both worlds. Consumer choice and financial use cases. Ultimately, whether crypto or traditional banking wins will depend on consumer needs and preferences. For day-to-day transactions, traditional banks are likely to remain the preferred choice for the foreseeable future, mainly due to their stability, regulatory backing, and integration into existing payment networks. Most consumers feel more comfortable using their bank cards or mobile banking apps for everyday purchases. Cryptocurrencies are increasingly seen as an investment vehicle or a hedge against inflation, similar to gold. They offer opportunities for significant gains but come with high risks due to their volatility. Investors seeking high-risk, high-reward opportunities might prefer crypto assets, while risk-averse individuals lean toward traditional financial products. Cryptocurrency also has a clear advantage in international transfers and remittances. Its ability to facilitate quick, low-cost transfers makes it an attractive option for people who need to send money across borders, especially in countries with expensive and slow banking systems. Conclusion: the debate between cryptocurrency and traditional banking isn't about one system completely replacing the other. Instead, it's about which system better serves different financial needs in an increasingly digital and interconnected world. Traditional banking provides stability, trust, and regulatory safeguards, making it indispensable for mainstream finance. On the other hand, cryptocurrencies offer a glimpse into a more decentralized, accessible, and efficient financial future, especially for those who are unbanked or underserved by traditional institutions. As technology evolves and the regulatory landscape adapts, we may see a future where both systems coexist, complementing each other. Traditional banks might leverage blockchain technology to improve efficiency, while cryptocurrencies could mature to provide greater stability and consumer protection. In this evolving landscape, the true winner will be the consumer, who gains more options, better services, and greater financial autonomy. Thanks for watching the video.